yet another week of Freightonomics. I'm head of Freight Market Intelligence, Zach Strickland, here with Chief Economist Anthony Smith. And Anthony, boy, do I have some questions for you.
I'm excited for it. I'm excited for it. I was excited for this day, and it's just so strange how everyone's accepting the news.
Christmas in July for an economist?
Yes.
You get
Yes.
a GDP?
We get Christmas 4 times a year.
I mean, so we're obviously going to talk about the rate hikes and the GDP release here today. So, but first things first, Anthony, tell the people what you're doing over
That's
there.
right.
You're not ignoring me. You're not ignoring me, but I feel like you are.
I promise I'm not ignoring you. If I'm looking down, I'm on LinkedIn, and we're streaming right now, live on LinkedIn. So if you're watching, it just so happens to be 12 p.m. Eastern Standard Time on a Thursday afternoon. Chime in. We're live. If you want to join in on the conversation, you have a hot take around today's GDP numbers, what's going on with interest rates, hikes, anything that has to do with freight or supply chain, or you just want to shout out good morning, wherever you might be in the world, hello, good afternoon, I'll be watching.
And of course, we have a lot of economic talk today to get into about the second half of the year, what some of this interest rate hike means. The consumer obviously starting to feel this in a bigger way. And there's a lot of questions around the timing of this. So is like, why are we seeing such quick increases and yet inflation is still not under control? So we'll address that here a little bit later. But first up, of course, I have created a new segment for those of you that just can't get enough of that freight market intel called the Market in 2.
Get my timer ready.
Yeah, you get your timer ready. This is where I go into some detail about what we're seeing in the data, of course, of the freight market in general and how to interpret it. So, Anthony, when you're ready, I want you to kick me off
All right.
for this Market in 2 update.
And go.
All right. So first up, we have a chart of the National Truckload Index, of course, measures spot market activity there in the white. The big takeaway here, not a lot of movement. There's not a lot of change week over week. We've hit a floor since about mid-May in the NTI. So spot rates have hit kind of a lower end boundary for the time being. In the blue line, that's our contract rate for van loads. So the contract market has not necessarily reacted to the spot market declines yet because they've been plateauing. And of course, contract freight rates move a lot slower because they operate on longer cycles. Now, the big takeaway here, though, green line, that is our spot rate, our NTIL, line haul only spot rate. And you can see if you exclude fuel, which also is excluded from that blue line that you see, the spot market is operating at a deep discount to the contract freight environment. So it's definitely something to watch there. If we move to our next chart, kind of look at something a little bit more leading our OTRI situation here. So tender rejection rates, of course, tend to lead the spot market by about 7 to 11 days in general. And this happened in March when they declined. Looking at the refrigerated, van, and the national index here, all of them are kind of coming down except refrigerated, slightly moving higher right now. A little bit of volatility in the refrigerated environment. The van, of course, coming down, settling. Let's move to the next chart. Here's the reason why we're seeing some of this refrigerated activity really pick up. ROTRI, SFO, and Fresno. So San Francisco and Fresno, refrigerated tender rejections hitting their highest levels in months. And you can see it's a very anomalous spike there for both of these markets. So produce season, still a thing. Definitely watch out on the West Coast and the Northwest in that reefer capacity segment.
Yeah, 10 seconds to spare, but
10 seconds to spare.
that is impressive, Zach. That is impressive. It's like I said, you've done this before a couple times.
A few times.
But
yeah, a lot of questions we get are around the refrigerated sector and its volatility. It's one of the most volatile sectors of the freight market environment because there's less of it. You can't cover, like van is kind of everywhere. It's ubiquitous. Refrigerated is very seasonal, very pocketed movements of freight. And that's definitely something to watch for those operating out on the West Coast. AB5 also has an impact on that sector as well.
Right. And when you're talking about, of course, the seasonality with refrigerated, what's been the latest seasonal trends? Were they kind of typical of what we usually see, or were they a little bit muted?
No, not at all. Seasonality really not a thing right now. I think Shelley Simpson actually did kind of reference it in her July outlook, saying we're seeing a seasonal trend. Well, read between the lines, they're starting to see some downward movement. I don't know that this is seasonal.
Yeah.
I think this is just them starting to feel that transitional state the market is in decline. Demand is in decline. Inventories are high. Therefore, shippers aren't moving as much goods, as many goods. And I think that's going to continue. Now, the big question remains, and GDP and interest rate hikes definitely going to play a factor here in the second half of the year. But first up, let's talk about some of this port activity with our news. Onomics, news of the day.
Onomics.
You talked about this yesterday, this first story that we have here. Significant shift in vessel calls to Port of Savannah helps drive record year. And I have a chart for this one because a lot of questions that I've gotten recently are like, what is this whole East Coast, West Coast interplay? It's not, hip hop in the 90s where we're debating, Tupac versus Biggie and whatnot. But it is an interesting situation where we've seen a lot of shippers push their freight onto these eastern ports. And this is a chart that kind of shows that. This is custom shipments, weekly customs shipments that come through the Port of Savannah and the ports of Los Angeles, Long Beach in comparison. And you can see 19% this week versus last week, or versus last year, the same week, up in terms of total shipments coming into the Port of Savannah. Versus last year, this time last year, Los Angeles, Long Beach, down quite a bit there. So this is why Savannah is growing, because a lot of shippers have shifted their port of preference into the East Coast because of the congestion issues. And of course, drayage is also a big factor on the West Coast right now, AB5.
Right.
But a lot of people didn't know this. So this was already happening before these shipments hit the ports.
So this has already happened before. Now we throw AB5 into the mix. That's only going to make things that much more exacerbated throughout really a sensitive issue, a really critical time right now.
Yeah, and I think the big takeaway here, a lot of questions that I've gotten lately too are around, why are we not seeing supply chains really untangle with this drop in demand? Well, if you've ever been paying attention, we're seeing a retraction off of all-time highs. So it's cooling down, but that doesn't mean that we have the infrastructure in place to handle what we have now.
Yeah.
There's still a lot of freight coming through the ports that was ordered months ago. There's still a lot of freight sitting around the ports that arrived months ago. And so until some of this logjam backlog gets cleared out, these ports and these upstream problems are going to persist. And I think they're going to persist well into probably throughout the third quarter.
Yeah, and one of the things that we mentioned, of course, you mentioned infrastructure. That's not something that can just get, rectified over the course of a couple months or a quarter here. That's going to be a year-long project, 2-year-long project, some cases 3-year-long projects on really fully building out some of these places.
Yeah, great point there. So the next news of the day I want to touch on before we get into our meat of the discussion about the macroeconomic situation. Todd Maiden wrote this article that basically summarized the sentiment of large carriers in the second quarter and the earnings calls. And I think this is a fantastic article. It kind of, if you don't have time to read through all the earnings reports, I do. I love reading them. I think they're fascinating. But you may not. This is a good kind of summation of the takeaways, the highest level takeaways. And really, large carriers still are still constructive on second half. So basically saying all these carriers sent out, and we talked about this a lot last week with JB Hunt, saying they still see plenty of tailwind heading into the second half of the year. And the reasons for that are pretty clear cut to us who are buried in the data and the numbers. Their contract rates still extremely lucrative compared to what they were even just a year ago. Yeah. So spot market operating at a discount to the contract market, but the contract market is at all-time highs still, and we're not seeing a strong downward contract. We're starting to see the earliest signs of those contract rates starting to fall a little bit, but it's still 11, 12% higher than year-over-year values.
So what would be something that would be a major shift in order to kind of bring some of those contract market or rates down?
Yeah, I think we're going to start to see those once these annual contracts start to come due. We're really in between negotiation. We're in between bid cycles right now. Right. Most of the bids, they were either deferred into later in the year or they're going to happen later in the year regardless. A lot of what we call bid season occurs in the third and fourth quarter. They start that process, they put it together, they send it out to these carriers, and then they start getting implemented in the first quarters in general, or fiscal year turnaround, so for budgetary purposes. And I think here in about September, October, we're going to start to see probably a stronger indication of what's to come.
Gotcha.
And it's going to last probably for a few months, depending on the spot market and what we see in peak season. If September, which I think is the month to watch for the freight market, if September is soft, September has actually been the peak month for freight.
Mhm.
If you look at the OTVI and spot rates, yeah, spot rates have kind of inflated.
Right.
But in terms of overall activity and volume, it's really been driven most in September, and December has kind of fallen off. We haven't seen that intra-holiday peak movement in terms of volume like we would traditionally see in years past.
And I think that's a great call out because there's some timings that we look for in order to see if there's some kind of a cyclical peak or seasonal peaks that we usually see. Last year during December, we're looking at inventories that actually ticked up in
Yep.
December, and that was really showing a shift in what we're seeing upstream happening, and it's starting to play out right now.
Yeah, and that's a big call out. You know, we saw actually consumer expenditures dip in December the last 2 years and rebound a little bit. So much more so in the last year versus this year. But it's kind of this non-seasonal tradition that COVID has kind of pushed on us. So the new seasonal norm for COVID has been September freight is peak season.
Yeah.
Are we going to transition back into a more traditional pre-COVID peak season that occurs around November, December, as some of this like last minute inventory gets off the boats and we start to see that happen? Because I think we probably will see a little bit of that this year, just
Right.
because of the fact that all these inventories aren't necessarily needed, and we have all this clutter in front of these orders that are going to come in later in the year.
Yeah, and one of the things that people sometimes ask me is like, hey, this is going to be deflationary, right? You know, you see all this stuff getting pushed out, and that's going to put some downward movement on certain prices. I'm like, yeah, to an extent, because they still have to get moved. There's still going to be a charge on some of those intermediaries, but there might be some deflationary, implications for some of these movements. But really, when the replenishment comes through for any of the seasonal or timely goods come through, that's going to be another one where producers are facing those inflationary pressures, and that's definitely going to be pricing.
Yeah, and I don't think you're going to be able to really apply any of the previous years to this one. Once again, sorry, demand forecasters and people that are projecting out into the future. I think we're also going to see, again, this is still a transitional state, which means that it's very unpredictable.
Right.
We have not fallen back into societal norms, nor have we fallen back into supply chain norms. And a few of the big call outs here from this article. Heartland Express noted that freight demand had stepped down sequentially from the first quarter. However, the carrier still finds itself in an oversold position. Fair enough. Like I said, coming down off of all-time highs. It's a good statement, I think. Landstar has been seeing pricing level from spot market decline that began earlier in the year. Revenue per mile for dry van loads hauled by its business capacity owners fell 6% sequentially in both April and May, but has held steady since. Kind of reminiscent of some other data we just showed you, NTI and of course OTVI. We didn't show you OTVI today, but both of those kind of flooring out through May and June and now into July. So Landstar probably still seeing some of that same fundamental stuff. So, big questions moving forward. The inventory dislocations and things like that are going to have a huge impact into the second half of the year. Dave Jackson, CEO of Knight-Swift, said supply appears to be leaving the market at a faster rate than demand is slowing.
That's an interesting take.
That is a big take. So that is basically saying we're seeing a lot of these operators leave the market. And I'd love to, see some of that data that he's looking at there, because I think he's right. I want to understand it. I want to know if it's leaving the market or if it's transitioning back into these larger fleets, which we noted in JB Hunt is absolutely the case.
Yeah, and how he really puts that weight on the supply side more so than the demand side is also, I think, a huge part of it as well.
Well, you know what he's doing here. He's lobbying for those rate increases. Dave, I get it. I would do the exact same thing. And you do have a case, and especially since he goes on to state, basically, we're much more sensitive to supply than we are to demand. And we didn't go into this one with a huge oversupply like we did in 2018, 2019, or like we did in 2006, 2007. Basically saying the supply side was not able to grow like it did in those cycles where we saw this transitionary state.
Right. Yeah, and like you said, you can read between the lines and see what he's doing there. But no, this is a huge take here. And like you said, I would love to see some of the data points that he's looking at.
Yeah, no, exactly. And I think they absolutely have a case for inflationary pressures keeping those rates higher. I'm an advocate for, operations not making 2-3% margins. I
Yeah.
think that's ridiculous. That's one of the things that leads us into these unmanageable situations when you have such tight margins. I think the industry in general, carriers are way underpriced due to their own doing, mind
Yeah.
you. They're bidding things lower just so they can survive.
Right.
But that's not a sustainable model.
No.
All right, let's get into the big news of the day. So we've got two stories here.
Yeah.
One, of course, the Fed raised interest rates by 75 basis points. And before this year, they hadn't done that since 1994. 75 another 75 basis point increase. And of course, we come out GDP down 9% quarter over quarter, the second quarterly decline in GDP. So Anthony Smith, first question to you. Are we in a recession?
Yes. Yeah. That's it. We're in a recession.
By definition.
It's fine. I mean, it's not fine, but a lot of people are saying like, this isn't a typical recession. And no recessions really mimic or really kind of copy each other, perfectly or anything like that. But a lot of folks are saying, this is not a typical recession because, look at the jobs market, look at the consumer strength, look at all these things. And that should be worrying that we're in a recession with all those factors really being in place in the first half of the year. And so once these factors start to kind of, deteriorate, that means the recession can get that much more worse as we get to the latter half of the year. The other big thing is that, of course, we were overstimulated throughout the last few years here, last few quarters here. So there's going to be a come down. So it's not too much of a surprise. But the big surprise is no one's really seeing how weak the consumer is and how fragile the macroeconomy is. Now, one of the big areas that's overinflated and in bubble territory is going to be job openings. There's no reason for over 11 million job openings. And we're starting to see a shift in that now. One of the big things that we're starting to see on a weekly basis is going to be initial jobless claims. That's starting to slowly but surely tick up. So in initial jobless claims, we're seeing that there is an increase that's really starting to show up. I think previous week showed that there was an 8-month high for initial jobs claims. And I think we're going to pull that one up here. And so we're looking at that trend.
That's a trend right there.
It's starting to move up.
That's an upward trend. So I mean, he stated that, Powell stated that the jobs market is still extremely tight.
Yeah.
Which I think that's true, right?
Yeah, it is.
This trend is basically stating that the market is already in a correctionary state, correct?
Yeah. And so this is what I think I mentioned it last week. Be mindful of the verbiage that's being used, that still at record highs or still at record lows, because those are going to be some lower data sets, but you don't have to wait until the proof is in your face to show that there is a downward movement from all-time record highs. Now we're nearing, record lows or something like that. So that's going to be one of those areas to watch, because this is going to be something that Powell, of course, is really trying to position the economy to be as strong as possible. And so it's no surprise for me that, these interest rate hikes are happening right now, because I think he sees, and a lot of the Fed sees, what's on the latter half of 2022, what's going to happen potentially in 2023. They need these interest rates to be picked up. They need these hikes because right now there's nothing in their arsenal to combat recessionary trends as we get a little bit deeper into this thing.
But aren't these interest rate moves very slow to have an impact?
It could be up to a year. It could be up to a year until you can start to see the impacts of it. But this is going to be one of those things because we haven't even really starting to see the quantitative tightening that was proposed so much. We've seen a downward movement in government spending over the last quarter. So that was a slight decline. I think it was down 1.9% over the last in the second quarter. So we saw some downward movement, but that can be attributed, of course, to the lack of stimulus, stuff like that, really kind of getting pushed out. But we haven't seen that true quantitative tightening in play just yet. So this is going to be one of those things where we don't know if it was a pump fake that we're saying, hey, we're going to do all this, we're going to do all that. It's going to be a good faith for a lot of investors saying, hey, I can continue to make these investments because the Fed is putting up a good fight for inflation. But that's going to be, like you said, a thing that's not going to really have any type of long-term actual play out for the next, 6 to 12 months here.
I mean, aren't we really just kind of, to me, it feels like the only winners in this type of rate adjustment are the banks.
Oh, for sure.
And the financial sector, because it's so fast and so rapid. You're really just pumping up debt and the cost of funds for people that are trying to borrow. It's not adding value, in my mind, to operations or anything like that. And in a way, it's seemingly, if you look at like the way that credit cards are managed, actually increasing the inflationary process. Am I right?
Yeah, and one of the things that you mentioned about creating value, creating essentially that value for businesses. Business investment moved downward in the second quarter, especially when we're looking at spending on equipment. And so that's going to be an area, of course, that is going to be impactful for freight and transportation.
Right.
Of course, if you're involved in the freight market, you're really operating in the supply chain, and you're looking at GDP. Don't look at GDP for really a measure or a gauge of how strong the overall freight market is. Of course, you can look at we have in Sonar is going to be the goods adjusted GDP. That's going to strip out all the services impacts that may not have a direct impact for freight and transportation, but also look to the other indexes, especially some that Zach mentioned at the top of the show, the NTI. That's going to be a much more better gauge for what the supply chain is looking like, what's going to happen in the truckload market. Look at volumes, look at rejection rates, look at spot rates, look at all these things that we have in Sonar to see what the strength of the supply chain or what the strength of your segment of the freight market is. Don't look at the overall GDP.
So, I've got to ask too, since, I kind of run through this in my head a little bit, and I'm not an economist by any means, but it feels to me like this corrective action is targeting the wrong sector because, when we look at our Sonar data, we're looking at flatbed rejection rates, your favorite index, and things like that show the industrial sector was really lagging. It wasn't part of this huge economic outbreak that we saw the early part of the pandemic and into really it was only the last few months of the pandemic era, as I would call it, that we had an industrial sector. Construction was relatively robust, but the industrial sector really didn't show up until maybe the last half of last year and then into this year. And that's really who these interest rates really have the most impact on, right?
Exactly. So you're looking at, so one of the ones that just came out today, durable good orders, so non-defense capital goods new orders. And it moved up slightly 0.5% on this most recent report, but we did see downward movement in, of course, the ISM PMI new orders component, showing that there's been a contraction for the first time in 2 years for ISM PMI new orders. We're also seeing that there was a first downward movement in 2022, down 0.2% for industrial production, which is going to be tangible industrial goods, manufacturing goods, over the last month here. And so when we're looking at these durable good orders, the upward movement overall should be noted. So we have durable good orders here. Zach, I got to mention durable good orders because there's certain components within it. One of them being defense spending. I got
a lot.
80.6%.
Oh my.
Monthly increase for defense spending. So when you look at where some of this increase was for the most recent durable goods report, look no further than defense spending, which is volatile.
You just threw an Easter egg at us.
Yeah, yeah. And this is something that's volatile. It's not going to be something that's, hey, this is a trend. When I was, doing executive consulting and forecasting, this is one that we're like, hey, yeah, we can kind of find some trends, but this is definitely a volatile area. This can be changed by geopolitical things. This can just
Obviously,
be changed
we have a pretty volatile geopolitical environment.
Exactly. And so this is going to be one of those areas that you don't really want to depend on for volumes or really look at, this is why it gets extracted out when you look at non-defense capital goods new orders on year-to-year or month-to-month level. So this is going to be one of those areas you watch. But really at the core of it, yes, we're in a recession. And no, it shouldn't be downplayed. And yes, it can get a lot worse depending on how fragile these macroeconomic indicators like the jobs market, the quit rate, things like that are really going to be into play. And of course, credit card spending. This has nothing to do with freight here, this next point that I'm making, but AT&T had a quarterly call. One of the areas that they saw a downward movement in was people being able to pay their bills. And so pay their phone bill. So that was one of those areas. We look at the jobs market in the previous report, we saw that there was a lower participation rate, but we did see a tick up in payroll. So that shows that more people are working second jobs. So this is really shaping up. I'm not, trying to paint a picture here, but kind of showing that the consumer isn't on as steady ground as some, people might say that they are.
So is this an overcorrection
with
the Fed's increase in rates?
I don't think it's an overcorrection. It's them trying to pad their chances at the latter half of this thing.
I just feel like they're creating their own environment to pad it.
For sure.
It's like they're
For
creating
sure.
the problem to fix later.
Oh, 100%. That's exactly what they're doing.
Oh,
and
man.
and when we were on, I think, what was it, Bill Priestley's roundtable,
Yeah.
and he asked us if we're scared of, the upcoming months. I've said I'm more scared of the potential solution that the Fed might try to use and
Oh my
implement.
gosh.
This is it right here. This is going to be some things that I'm going to be fearful of, how they try to fix this thing.
Well, the only thing to fear is fear itself, Anthony. So,
Wise word.
yeah, that'll wrap us up for this week's Freightonomics. Of course, reach out to us, watch us on YouTube, hit that like, thumb up. I know they got rid of the thumbs down, but it won't hurt my feelings.
We're tough around here. Also, drink more water, hydrate.
Get good sleep. I read a good sleep study this week, and it just shows how important